particular module B, we are looking at again 7 units are there, Unit 8 to Unit 14. PMLA, NI Act. Important out of this is this our NI Act. Then FMA, all those things, some different acts are there that will also be looking in this particular module. First we start with the Prevention of Money Laundering Act 2002. The way back in 1998, the United Nations General Assembly said they made a political declaration. What they said was that all member states means the countries should adopt national money laundering legislation and program. This is what they said by United Nations. Unfortunately, what happened after the UN guidelines were given like this, some governments have passed the guidelines, some governments have not passed the guidelines. Somehow it went here and there. After this declaration was given by the United Nations, in USA that the Twin Towers World Trade Center was attacked in 2000. Okay, it was September 2000, September 10th September 2000. Twin Towers have been attacked. Okay, I was in USA up to August 2000. Only after that I came back from in the month of August, and then this happened in September 2000. I was posted in Bank of India's New York branch. I worked there for 4 years. So I left in 2000, around August, August I left, I think. Thereafter, anyway, this one. Now, once after that incident has happened, then naturally it happens in USA. Everybody will be, terrified. So then every governments were required to pass this Anti-Money Laundering Act. Accordingly, Government of India also passed the Act in 2003, but made effective from 2005. This is basically the Act, Anti-Money Laundering Act. The authority to implement this Act is Director of Financial Intelligence Unit. Remember this. India FIU-IND is the Director of Financial Intelligence Unit, is the authority to implement the guidelines under this particular Anti-Money Laundering Act or Prevention of Money Laundering Act. It is not actually Anti-Money Laundering Act, it is Prevention of Money Laundering Act. Okay, there are 3 objectives here for this act. One is prevention, control, both are there. First, they should see that they do not happen. If they are happening like that, it should be controlled. Second is, in case any properties are acquired or any benefits are derived thereof, or any assets have been created out of this money, then they could be confiscated or seized also by under this particular act by the FIU-IND. Then any other issues connecting with the Money Laundering Act. Any other issues means giving guidelines to the entities who are dealing with the financial products. So this Anti-Money Laundering Act or Prevention of Money Laundering is more relevant for the bankers, because whenever the funds are moved from one place to the another, whenever the money is, we will use this word, black money is converted into white money. In fact, black money is, there is no word at all in this entire guidelines. We normally use this word. Or tainted money is being maintained into untainted money. This is money laundering process. Banks are the first source for conversions. So these guidelines are more relevant for the banking sector. Another important sector which is affected by this money laundering activities is the stock markets. People put money in the stock market and they try to make it into white money or a properly secured money. Third one is that now you can see FCRA, Foreign Contributions Regulatory Act, FCRA, where foreign contributions are being received into the country, making black into white or white into black. So regarding these kind of situations also, the DIA, the FIU-IND can give the instructions. These are the 3 concepts of the objectives of this passing this particular act. The money laundering takes place through 3 stages. One we call it as placement stage, second is called the layering stage, third is called integration stage. They are asking the examination this question also, what are the One of the following is not steps in the money laundering: placement, layering and integration. Now, normally this black money what we use is the money which has not been properly accounted for taxation purposes is called is called tainted money. I will give an example how this word is very effective. Then we can also understand how this situation takes place. I take a common man's example, not the big people. I can't take it. I take a common man's example. Let's suppose somebody purchased a property worth 1 crore rupees. Now normally what will happen? The seller will say, sir, I had to pay stamp duty, or the buyer will also say, sir, I had to pay stamp duty for 1 crore rupees. What I do is that confirm the sale for the market value of the property, so that I need not pay that much stamp duty. So let us suppose market value of this particular flat, which is 1 crore, which is purchasing, let us suppose 60 lakhs rupees. So then what they are really doing? They are entering into a contract, registering the property for 60 lakhs rupees. So for 60 lakhs rupees, he gives a check or a draft or whatever it is, things are done. But what about the remaining 40 lakhs rupees? The 40 lakhs rupees he gives as a check, he gives as a cash, or maybe he gives as a some kind of transfer to other accounts. So ultimately what is happening? The buyer of the property or the seller of the property is making cash payment, tax payment for 60 lakhs rupees only, and again 40 lakhs which is being received as a different payment is not accounted for in the books of either the buyer or seller. In fact, that 40 lakhs is a black money. This is one simple transaction which I told you. Then this black money could be generated by bribes, corruption, extortions. They are all extreme situations, criminal situations. They also generate this kind of money. So any transaction done where not only properly brought out in the accounting books is treated as a money earned out of tainted activities. Now this 40 lakhs he has taken as a money. Then how he has to put it in the banking channels now? He has to make it white now. What he will do is, first step he will do is a placement. Now what he will do, he will go to different banks and he will open accounts in different names. Maybe one account in his wife's name, one joint account with him and his wife, another in child name, so then servant maid name, servants names, different accounts he will open. Okay, he will give KYC, Aadhaar card and all, he will give KYC. And this 40 lakhs he will deposit in say 5 accounts. 8 lakhs rupees he will deposit. Because 8 lakhs is a small money, up to 10 lakhs rupees it need not be reported to RBI, to FIU-IND. So this amount comes into the banking channels but without being reported to any authorities. Now 40 lakhs has adjusted in 5 accounts. 8 lakhs, 8 lakhs, 8 lakhs, each has adjusted it. That is first stage called placement. Next stage what you do, you will layer the amount. So now he is already having an account. From each account, all these 5 accounts, he will transfer 2 lakhs to this account. If the bank asks you, where from you got 10 lakhs rupees in your account, when in the layered account he will say, sir, Mr. So-and-so paid me 2 lakhs, he paid me 2 lakhs, something he will say. So small amount, no, not noticed for any triggers. But what he has already done, 10 lakhs rupees he has placed in his account. He has layered and kept it in his account. So now like that, maybe after 6 months or maybe after 1 year again he will shift some more money into this account. This stage is called layering the account. Then integration. Now whatever money is now coming to means slowly that 40 lakhs is coming into his account, but not directly by a deposit by him, by transfer from different set of accounts. Banks cannot go to further sources to find out where from the money originated. They are only sufficiently proven that it has come through banking channels. Once the money is sitting in his account, he will use this money either for buying shares or securities, or maybe availing another housing loan and showing this money as a margin money for the loan, or different, making fixed deposits, All these things he will do and integrated. That stage is called integration. So placement, layering and integration. Through integration, whatever he got on money, that 40 lakhs is now integrating into the financial situations. He brought into the market. So this situation is called this process is called money laundering process. Normally, when the bank asks you, you have wanted to avail a housing loan of 1 crore, the borrower says, sir, I will give you a margin of 40%. 40 lakhs I will give you. The bank is also happy, higher margin they are getting. Then they'll ask you, where is the 40 lakhs? Sir, this is in my account. Then if a bank officer wanted to further probe it, he will ask you how you got 40 lakhs. Sir, I got this amount. You can also see from NEFT or RTGS, the credits are come into my account. So banker is happy. They have come through banking channels. If you had deposited cash only, you would have objected it. This process is called the stages of money laundering. The placement, layering and integration. Okay. Now, section 3 of the Act says, what is the guilty of money laundering? Now, I simply told a bank simple transfer. It is not just the money laundering. There are 6 situations if they are observed by the FIU-IND or the enforcement directorates appointed by the FIU-IND. They are all treated as guilty of money laundering. One is concealment. Okay, you got this money like this and concealed from the reporting authorities. Yesterday I was reading in a newspaper, a RTC bus driver in Hyderabad. RTC bus driver in Hyderabad. Recently, somehow they raided his house. They found out that 15 crores of cash in his house. 15 crores of cash in his house and gold. I think 500 grams of gold or something like that. It was found out in his house. Means how he got it? Did he get it from his employment, or did he get a jackpot in Dubai or USA? No. Somehow somebody would have given the money to him to conceal it, and it was found out from his house. So concealment is also a guilt of money laundering. Possession, not only concealed, you are holding it, acquiring it, using it, projecting as untainted property. Projecting as untainted property. So let us suppose there is a flat in my name. Then I found out that, then say the FIU-IND found out I have property in my name. Then I asked them, how do you got that? He says, sir, I did not, somebody has gifted this property to me. So it was not acquired by me, but somebody has gifted to me. So he will show us a sale, the gift document or something like that. So he says, sir, I have not got my own source, but somebody gave it to me. Like that also, if it is found out that it is a projecting as an untainted property, claiming as untainted property. For example, I am working in a bank. I am a manager. Okay, now every day I come to office through a BMW car. Then somebody asked me, how you got this BMW car coming to the office? Normally, the BMW in India costs about 30-40 lakhs rupees. Maybe I cannot afford such a BMW car. Then I will say, no sir, this car has been gifted by my father-in-law. So how he has gifted you 26-30 lakhs car to you? So therefore I will say, means you would have purchased it from his own source through an intermediary, and he says it's an untainted property. So all these things, if they are found out in any transactions done by the individuals or groups, is treated as the guilty of money laundering. Remember these 6 points, not much explanation, 6 points. Then in case somebody is found out of money laundering activities, punishments are very, very severe. Under section 4 of this act, 3 years up to 10 years, 7 years. And subsequently, in case it is offences regarding narcotic drugs, then it is 10 years. This is a punishment under the act. Further, there is now all these money laundering activities are happening through financial intermediaries. Whenever we use the word financial intermediaries, one is the banks, second is stock markets, third is foreign exchange services, and fourth is insurance markets. Okay, insurance markets. Okay, so now whenever the funds are routed through any of these financial institutions, or intermediaries, it's the responsibility of the financial institution to verify the credentials of that particular person. This is called reporting entity. Reporting entity means not only banks, stock brokers, stock exchanges, then mutual funds, insurance companies, foreign exchange services, all these things come as the reporting entities. They need to verify the credentials of the customer. The one word they use is, look at these words, verify the identity of its clients and the beneficial owner. These are the two words they are using. What is beneficial owner? We will discuss in some other slide. They have to identify that person. For that purpose, they also have mentioned what is the identification procedure, maybe through valid, officially valid documents prescribed as passport, Aadhaar letter, etc. As far as the banks are concerned, Reserve Bank of India has given different guidelines how to identify the beneficial owner. The KYC guidelines, what we are speaking, know your customer guidelines, due diligence, etc., is relating to this concept only. Based on section 11 of the Anti-Money Laundering Act, KYC guidelines were issued by Reserve Bank of India. KYC guidelines cover 4 important factors. I do not know you are aware of this or not. The KYC policy given by RBI in identifying the beneficial owners is consisting of 4 policies. One is customer identification policy, first is customer acceptance policy, customer identification policy, risk management, monitoring of transactions. These 4 guidelines were given by Reserve Bank of India for all the banks which are connected with this kind of financial activities. They also have mentioned what documents you should obtain to identify the entity. For example, in case of an individual, you can take one of those OVDs, passport, Aadhaar letter, driving license, voter card, like that they have mentioned that. Let's suppose a transaction is done by a partnership firm. It's not just sufficient to obtain this. Then you have to obtain the registration certificate, licenses, so many things. So that's what RBI gave the guidelines. So based on this section 11, different regulatory authorities also have given certain guidelines. Further, section 11 also speaks about maintaining the records. As per PMLA guidelines, they said that all records are to be maintained by the regulated entities for a period of 5 years after the conclusion of the transaction or from the date of the transaction. For example, today somebody has taken a demand draft. So for example, 1 lakh rupees. Then you have taken the transaction records you have to maintain for a period up to 5 years. Means you have already given a draft, the payment has been made, so the records are to be maintained for a period of 5 years. This is what the section 12 of the banking, the Anti-Money Laundering Act speaks about that. Okay. Then, along with the Anti-Money Laundering Act, Prevention of Money Laundering Act, they also passed one more act called the Prevention of Anti-Money Laundering Act rules. One is the act, second is the rules also they are passed. Rules means act always speaks about the specific guidelines, how they are to be implemented, what type of documents are to be obtained, what type of reporting has to be made. They are not given in the act. They are given always by different rules they will give. For example, you have Companies Act. You will also have company rules also. You have Prevention of Money Laundering Act. You will also have Prevention of Money Laundering rules also. You have Income Tax Act. You have Income Tax rules also. So both the things we have to read to understand any act. Simply by reading an act, you don't understand the guidelines. Only in Banking Regulation Act, fortunately, we don't have banking regulation rules. We only act only. RBI Act is only there, no rules are there. So under rules, they have said what information are to be submitted to the FIU-IND. They have said. So they are go through different kind of statements. One is called CTR, Cash Transaction Report. Second is CTR, okay, Cash Transaction Report. Second is CCR, the Counterfeit Currency Notes Report. Then STR, Suspicious Transaction Report. As far as the banks are concerned, they need to report all these transactions to FIU-IND. they also have given the value above which the transactions will be reported. What it says, any transaction conducted in an account during a particular calendar month, if it is more than 10 lakhs, a single transaction, it will be reported to the FIU-IND under CTR report. Remember the limits, more than 10 lakhs. Okay, or a series of transactions happening in an account which is more than 10 lakhs rupees, all those such transactions are also to be reported. Let's suppose in a particular month, a customer has deposited 2 lakhs rupees on 1st of the month, and 10th of the month he has deposited 5 lakhs. So 2 lakhs will not go, 5 lakhs will not go immediately. Now next he has deposited say 3 lakhs, 5 3 plus 2 10. Then thereafter he has deposited 1 lakh. Now total amount become now 11 lakhs. Now what will happen? All these transactions will be reported to FIU-IND. And when we are reporting these transactions, we don't net it up. Debit transaction separately, credit transaction separately. We will report all these transactions. All these transactions are reported. I will show an example which RBI has given, which transactions will be reported to FIU-IND also. This is called CTR. Second is, if the counterfeit currency notes are received by the cashier, then that also need to be reported. Okay, here all currency notes, even if you are going to get one counterfeit currency note, when you are accepting cash from the customer, it need to be reported under reporting called CCR. Okay. Third one is STR, suspicious transaction report. Wherever you find a transaction is suspicious conducted by the customer, you have to report it immediately to the FIU-IND under STR reporting. Remember the limits, and of course due dates are not much required. 3 reports, CTR, CCR and STR. Normally these are directly done, the CTR is directly done by the head office. CCR and STR has to be done by the branches, okay, through head office. Okay, this is as per Rule 8 of the Prevention of Money Laundering Act. Reserve Bank of India gave an example which transactions are reported. Okay, one example they have given also. In this particular account, you can see some debit transactions have taken place, some credit transactions have taken place. Now debit transactions, 5 lakhs 40,000, 4 lakhs 70, total 10 lakhs 10,000. Credit transactions 3 lakhs, 2 lakhs 1,000, say 6 lakhs is the transactions. Now they say which transactions are reported. Now in case of debit transaction, the amount exceeded 10 lakhs rupees. So now what we have to do, all transactions in this debit side will be reported. But here they say transactions less than 50,000 need not be reported. So 5 lakhs, 4 lakhs 70,000 will be reported under to FIU-IND under CCR transaction. So reported to under transaction. Now what about credit transactions? It did not cross 10 lakhs rupees. He says all credit transactions in the example would not be treated as integrally connected, as the sum total of the credit transactions during the month does not exceed 10 lakhs, and hence credit transactions need not be reported by the banks. So if it's we have this, when we are counting this 10 lakhs, we should not add up debits and credits. Debit transactions are separately reported, credit transactions are separately reported, provided they are crossing 10 lakhs rupees. Any transaction below 50,000 need not be reported, but for adding up or summing up, that amount will be taken into consideration. Okay, na? These are some examples they have given. Just go through that. There is another rule. This is not Act guidelines or rule guidelines. Client due diligence has to be done. It means if any transaction has been happening above 50,000 rupees, so due diligence has to be done. Then what do we mean by client due diligence? This is one important concept, CCD. CDD normally they call it. Due diligence is identifying the person who is conducting the transaction. Then how do you identify the person conducting the transaction? By obtaining any of the OVDs specified by RBI. RBI specified what document you have to obtain to verify the identity of the person when you are conducting the client due diligence. Let us suppose somebody came to take a demand draft for 20,000 rupees. You need not take any due diligence because amount is below 50. After 1 hour he came for another demand draft for 40,000 rupees. Is again below 50. You need not do any client due diligence. But if you do look at the total transactions he has done on the particular day exceeded 50,000 rupees. So due diligence is mandatory here. Then he is not your customer because below 50,000 he can accept cash also. Then what to do about this? So therefore in such cases we need to identify that person who is making this remittance. Then you have to ask for one of those proofs to give it to you. Maybe you take a Aadhaar copy or you may take a passport copy, etc. Earlier PAN card was one of the OVDs, they are removed now. So one of those things you have to keep it, take it and keep it on record. This is one. Another it says the client due diligence has to be carried out on beneficial owner also. Who is this beneficial owner they are talking about under Rule 4? In Rule 9, they have mentioned who is a beneficial owner. They have mentioned. Okay, first let us see who is a beneficial owner. In case of a company, if anybody is having a controlling ownership, 10% of shares or capital or profit is treated as a beneficial owner. Partnership, more than 10% of capital or profit. Unincorporated institutions 15%, trust 10%. Now how to read this particular slide? Let us look at that. Take a partnership form. There are 4 partners are there. Each one is having 25% share in the partnership. Capital, each one is 25%. Now the partnership deed says that out of these ABCD partners, A and B will be operating the account. All 4 partners do not operate the account. A and B is operating the account. Now they came out with the partnership deed. You have verified the partnership deed. You found out that A, B, C, D are 4 partners. Each partner's share in the capital is 25%. So A and B are authorized to operate the account. You have opened the account after obtaining A and B signatures on the application form. Since they are signatories to the application, you need to obtain your KYC documents. Okay, there are 2 types of KYCs. Remember always. In case of different types of customers we get, do you remember yesterday, the first day of the presentation I was talking about the public. Acceptance of money from the public. They said use the word public. Who is this public? I did not explain there. I am explaining it now. The word public there means it is could be a legal entity or a non-legal entity existing in the country. That is called public. So okay, remember that word. Who is that public? Legal entity or non-legal entity. Legal entity means this is constituted by a certain act of the government. Is called legal entity. For example, partnership form. Partnership form is a legal entity because it is formed under Indian Partnership Act. A company is a legal entity formed under Indian Companies Act. Trust is a legal entity formed under Indian Trust Act. Society is a legal entity formed under State Societies Act. So HUF, there is no legal entity. Then you have the LLP, passed under the LLP Act. One person company, Companies Act. So whatever the body that's formed under a particular act is called legal entities. Who are non-legal entities? Individuals like you and me. We are not formed under any act of the government. And proprietorship forms, there is no legal, they are not legal entity. Even HUF is also not a legal entity. So these non-legal entities and legal entities we are looking at. Now this is what the term used as public. Okay, now this is a legal entity formed under the Indian Companies Act. Now A and B, you have scrutinized it. A and B are the operating, you have taken the so whenever you are obtaining a what you call that due diligence, you have to do 2 diligences in case of legal entities. First due diligence is on the people who are operating the accounts. Second due diligence is on the legal entity itself. Remember, this is the guideline. What is the first due diligence? On the legal entity itself. Let's suppose the partnership form. How are you going to do the due diligence on partnership form? You will take the registration certificate, you will take the partnership deed, you will take the licenses issued for them for doing the business, maybe GST, maybe tax returns, financial statements. These are all the things through which you are identifying this particular entity is is a legal entity. Then that due diligence is over. Now you have to further do due diligence on the operating partners. A and B are the operating partners. You are doing due diligence on A and B. You take their Aadhaar card and you photographs and all, that is done. But what about C and D? What about C and D? Now this rule 9 says that C and D is treated as a beneficial owner. What is beneficial owner? Since he is having the share capital more than 10%, means he is having 25%. You also have to carry due diligence on C and D also. Means even though they are not the operating partners, you need to carry out due diligence on C and D also. So what is due diligence for them? Simply you have to take their photographs and then what you mean what you call that the Aadhaar card or something like that, and you have to keep on record. This is what the term beneficial owner means, right? So different types, different stipulations they are made. Then another guideline given is all non-profit organizations should register in Niti Aayog's Darpan portal. Okay, so these are all some guidelines which we are talking about in the Prevention of Money Laundering Act.